Tesla will report fourth quarter results after the close today. To prepare, we're going to do our usual analysis of going through management's guidance that they provided in the last shareholders letter and comparing the resulting earnings to the consensus estimates. And then we're going to run some sensitivity analysis on some of the more important assumptions in our model, including the ramp of production of Model X and the CapEx assumptions, particularly when the Model 3 CapEx is going to come into play. If you'd like to download our earnings model and follow along, please visit our website, gutenbergresearch.com. Click on the Free Models tab, and then you can scroll down to the Tesla model and just click this button to download. And if you're new to our approach, please visit the Education tab, and from there there's a document that goes through our entire financial modeling and equity valuation approach, and it uses Apple as an example, but Tesla pretty much follows the same methodology. So it can be pretty helpful for this one as well. Alright, so let's take a look at the guidance that management gave us. And there's a number of different things here, lots of puts and takes, particularly on the revenue line. So you can see right here in our model that for the next quarter, we have revenue currently in line with consensus estimates of $1.81 billion. But there's a number of things that we need to think about there. So what we're going to do is sort of go back and forth between the shareholder letter and our model to see how we got back to total revenue. And really what we're doing here is we're backing into the average selling price for the Model S, since that's the majority of the sales for the fourth quarter. And then we're going to see if that ASP makes sense based on what management told us last quarter. So when we think about Tesla's revenue, there's really 5 main components there. There's the Model S revenue, Model X revenue, zero emission vehicle credits. There's the energy products, which come through the service and other category. And then there's a lease accounting adjustment, and that would be in the non-GAAP adjustment section of our model. So let's go with the Model X component first. So we already had the disclosure in early January that they delivered 208 Model X vehicles in the fourth quarter. And so there's not going to be a huge contribution of revenue there. For the time being, we left the average selling price at $130,000. Then let's take a look at the zero emission vehicle credits. So they gave us guidance in the shareholder letter over here that said that they do not expect to sell any zero emission vehicle credits in Q4. So we left that at 0. For the other service and other revenue, we kept the growth rate from the third quarter about consistent with the historic results. And then for the cars leased, they already gave us guidance that the percentage of cars leased versus sold was going to be consistent with the third quarter. So we left the non-GAAP adjustment consistent with the third quarter on a per revenue percentage basis. And then that leaves us with the Model S assumptions. So we also got a disclosure on the total units delivered at 17,192 Model S vehicles. And we know what the consensus revenue estimate is. It's $1.81 billion on a non-GAAP basis. So we backed into the average selling price of the Model S that would get us back to that non-GAAP number, and it ended up being just over $98,000 per Model S. Then when we took a look at the shareholders letter, we were trying to make sure that that made sense. They did say that they expected the average vehicle sales price to increase slightly. And although we don't know what the definition of slightly is, when you look at the composition of the total vehicle deliveries, including Model S and Model X, the average selling price went from $96,600 per vehicle to $98,800 per vehicle. So that's probably fits that definition of a slight increase in average selling price. Next, we can move on to the non-GAAP gross margin. So management expects to see a slight decline from Q3, and you can see that we have a 20 basis point decline. So again, we don't know what the definition of slight is, but 20 basis points is probably fine. And in our model, you'll see the gross margin start to improve throughout 2016 as the Model X continues to ramp. From there, we can move down the income statement to the operating margin. And really there's just two OPEX items, R&D and selling, general, and administrative. So they did give us a little point here that they expect operating leverage to improve and gross profit to grow faster than operating expenses. And they expect operating expenses should increase slightly in Q4. So what we did is we brought down the R&D as a percentage of sales in the fourth quarter, and that's really to recognize the fact that the majority of the expenses related to Model X have probably already been incurred at this point. And then we just checked up here in our income statement that our total non-GAAP operating expenses have increased sequentially from third quarter, so that they're in line with this statement from management. So now that we have all of management's guided ranges included in our model, we can just take a look and you can see that we were in fact able to get back to the consensus EPS estimate on a non-GAAP basis of 8 cents. And there was only a couple of assumptions that we had to make past the operating income line, just for interest income, which is up a little bit because we have the additional interest related to the convertible notes that were issued not long ago. And then we have other income, which we kept pretty much consistent with the third quarter, although it's on a lower revenue base in the fourth quarter here. And provisions for income taxes are relatively low, so not a huge contributor to earnings at this point. So we would say that overall, the street is in line with management's guidance given on the last shareholder letter. For the full year 2016, we also have our model calibrated to meet consensus estimates for both revenue and EPS. Just keep in mind here that we did bring down our total vehicle delivery assumptions in 2016 from what we had after last quarter, and that's really just to reflect the fact that they hit the low end of guidance for the fourth quarter. So you can see that on the last call, they expected to produce between 1,600 and 1,800 vehicles per week, which would be approximately 83 to 94,000 vehicles for all of 2016, and we're currently modeling just over 80,000 vehicles. So there could be some variability there depending on what kind of guidance, updated guidance we get for 2016. Now, before we run our sensitivity analysis, let's take a quick look at our valuation heading into this release. So our Tesla model is a tier 1 model, which means we use both the multiple valuation and a discount on cash flow valuation, and then you take a 50-50 weighting of the two approaches. So for the multiple valuation, we're using a price earnings ratio based on the 2016 consensus EPS estimate of 154. So we're looking at 99 times that estimate, and that's excluding the value of net debt per share, and that gets us to the 148 valuation. Then for our discounted cash flow valuation, we're using a beta of 1.25, an equity risk premium of 5.1%, and a weighted average cost of capital of 7.6% with a 2% constant growth rate for the terminal value. And that gets us to a 162 valuation. And then the 50-50 weighting of the two approaches is 155. So keep in mind that when we update our model tomorrow after the earnings call, or excuse me, tonight after the earnings call, we will keep the multiple and the DCF inputs constant so we can isolate the impact of the value change that's related to earnings only. That way we can see if the price move in after hours makes sense. And now I'd like to run some sensitivity analysis on the model. We'll start with the Model X production assumptions. And really, as I go through this, I'm just demonstrating how you can change this model for yourself. So if you want to download it from our website, gutenbergresearch.com, and you can just plug in your own assumptions and see what the impact is. So let's focus on 2016 for the time being. And right now we've got relatively conservative assumptions for Model X because management did say that they were running at about I think it was 387 vehicles per week production on the Model X at the end of the year. Excuse me, it was 238 vehicles. So producing 1,000 vehicles in the first quarter is probably somewhat conservative. So let's up that by changing this percentage increase. And you can see it's very high because we're really ramping quickly. So really, when you change the model, you're going to want to stick to the blue cells so you don't interrupt any of the other equations that are working behind the scenes here. So let's change this to 1,000% increase from the fourth quarter. So they're going to ramp very quickly. And we kept the other assumptions the same. So now what did that do to our total vehicles produced for the year? Brought it back up to 88,000, and most of that is now, well, not most of the vehicles, but that's a huge growth in the Model X vehicles, which are at a higher price. And they start at a lower gross margin compared to Model S, but by the end of the year, we have them meeting the same gross margin as Model S at 26%. So you can see that that moved our 50/50 price target to just over $200, and that's only changing the growth rate in the first quarter. So you can see how sensitive our model is to the production of Model X. So we'll undo that. And now let's think about the CapEx related to Model 3. And let's say that a lot of the CapEx comes in 2017. So you can see they did give us a little bit of guidance here that they expect the remainder of the year to be about $500 million in CapEx. But let's say that they're going to ramp and need maybe $1.5 billion in 2017. So we'll make this easy and we'll do a goal seek function here. So if we want 1.5 billion in 2017, and we'll just say the majority of that's going to come in the beginning of the year. Okay, so we got to 1.5, and now if we take a look at what our net cash position is at the end of each period, we're still doing okay until the fourth quarter of 2017, and then we actually have negative cash. So what this is saying is, if they're going at the same rate and all the other assumptions stay the same, but that the ramp in Model X is a little bit slower, and so there's less income coming in and producing additional cash flows, and if the ramp of Model 3 comes earlier in the process before they hit that inflection point and start to really grow their cash flow from Model X, then they're going to need some sort of funding to keep their operations growing. So be that an additional equity raise or some more convertible notes or just straight debt. You know, there is definitely some execution risk, and we'll just have to keep an eye on the cash burn and the CapEx assumptions here. So I will undo that for now, and feel free to download it and plug in some of your own assumptions. And definitely join us after the call. We're not going to be posting a video, but we will be posting an update on our model blog. So you can see that here. If you click on this tab, you can see that we've been blogging out our updates as we go. And we also post our models there as well, so you can download our updated model from the model blog or from the free models tab after the earnings call tonight. If you're interested in financial modeling, please be sure to subscribe to our YouTube channel and follow us on Facebook. And thanks for watching.